Well, Naspers is a good performer, great performer if you've been following the shares. If you happen to have bought them around 400 Rand a share, and they're over 1,000 Rand a share, I think you'd be smacking your lips, and that's happened only in the last 2 years. But if you had the chance, would you trade your Naspers for a company like Sinomedia? Sino who? Geoff Blont is the chief executive of Canon Asset Management, and your guys have just put together, Geoff, a report on this and saying, well, why buy Naspers if you can get Sinomedia? And I suppose you might really be saying many other media companies that are available in China to the investors today.
No, absolutely. I suppose it's a bit disingenuous because we're using Naspers as a proxy for Tencent. So the reality is, well, why buy Tencent when you can buy Sinomedia, or for that reason, other businesses that are exposed to, let's call it the Chinese media technology sector, to social media. The conventional wisdom goes, doesn't matter what you pay for Tencent, you're going to make money out of it. And we just think that perhaps there's better opportunities. The one thing is you can buy Naspers in rands, and if you want to buy Sinomedia, you have to take your money out via your allowance and buy the share directly. But it is a proxy for lots of businesses in Hong Kong and in China that we think can give you the Chinese, let's call it growth story in the sector, but at significantly lower multiples.
Well, both you and I have seen this movie before. Do you remember a stock called Dimension Data?
Absolutely.
Well, you can't lose money on Dimension Data. For years you couldn't, but then you did.
In the late 90s, I was a fund manager at BOE Private Bank, and I remember we had a saying, you're damned if you do and you're damned if you don't, because you knew that data was expensive, but if you didn't own it, your clients fired you. But you knew you were buying something that ultimately was actually a bad decision. And this is the issue of, can markets or pricing stay rational longer than you can stay solvent as a fund manager? In Sinomedia, though, we think that there's a nice comparison in that you are, if you dig around, able to find not equivalent, but businesses that have similar potential markets and have similar growth drivers, but at considerably cheaper multiples.
So the easy way, if you're sitting in South Africa, buy Naspers, you're getting 34% of Tencent, which everyone around the world is in awe of, the entrepreneurship and the development and the growth. But there comes a time when better value is available in similar companies, as you were mentioning, in the Chinese market. Would you look at Baidu, Alibaba, which is now going to be listed in the Chinese market? Is there a smorgasbord of opportunities?
I think there's quite a large set of opportunities. The issue again, what is the pricing? I mean, Alibaba looks like it's coming to market and it's going to be expensive. So I wouldn't look there. The issue with Tencent, once again, it's maybe just to revisit that thesis. And I think this is what you've got to understand when you buy any of these expensive companies. It's a great business with great potential, but Tencent's cost of capital at the moment is 9.5%. Okay. Its return on invested capital is in the mid-50s. I think it's 55%. It means for every dollar that they've got, they invest $1, they make a 55-cent return, but that dollar's only cost them 9 cents. So they make a 45 cents profit per dollar invested. You've got to understand, when you have those types of margins, people come for your lunch. And we know in the technology sector, which things evolve dramatically. By the way, interesting enough, these numbers are not dissimilar to Microsoft in 2000. The multiple plus the return on invested capital.
But are they similar to Google? Because no one's managed to crack Google yet. So if you can't crack Google, maybe you can't crack Tencent.
Do you remember, now the name escapes you, so those other fantastic search engines that existed in the
Alta Vista, I remember them all.
Those were the.
They were never Google.
Well, yes,
Buffett says he can't crack the Google model.
Potentially, if you have a natural monopoly that evolves. I think
has Tencent not got that?
It potentially has, but there's two aspects then. Maybe the one is that people do come for your lunch, but perhaps they don't. So perhaps you maintain those margins. The next thing then is, if you look at the valuation, you pay for it. So you're paying via Naspers a 60, 65 PE for it. Now, what we did is we did an analysis and said, well, if you pay that PE, people say it doesn't matter what PE you pay for it because the earnings will justify it. We said, let's rather reverse engineer that and say, what does that PE tell us is priced in the earnings growth? So in other words, what is that 65 PE? And if you work out cost of capitals and you model the business, it means that Tencent has to grow its earnings every year for the next 10 years by a minimum of 25% per annum.
And you think that's not likely?
It's possible, but remember that's to break even on the share. So if you buy
Yes.
it now, that's so it's not to initially make a profit on the
So
share.
you're buying the stock today
No.
at this level
Price. You've
on
got
the
to-
assumption
so-
that it's, or you believe that
Yeah.
the shares, the earnings are going to grow 25%. It
the
doesn't
trick-
look too high.
If
Doesn't
the,
look
well,
too
the
tough.
trick is if it grows earnings at more than 25% per annum for the next 10 years, then perhaps it's worth looking at. If it's not going to grow earnings at that level, you're going to lose money. If it grows earnings less than 25%, it's a big ask. Now, funny enough, I go back to the Microsoft example. In fact, the numbers of Microsoft were actually almost identical. So in 2000, the inferred earnings growth for Microsoft for the next 10 years was 25% per annum. Natural monopoly, every computer's got one, and we know that. We've seen that Microsoft dominates
So
the world
really,
of
really good parallel.
Yeah,
Thanks, Geoff.
but-
And one that I guess people should be having a
Very
look
well,
at
yeah.
and picking up on.
Absolutely.
Thank you for
Yeah.
your insights. That was Geoff Blont, who's Chief Executive of Cannon Asset Management.